Good day, class. I welcome you to today's edition of online class. Today, we are going to be looking at ratio analysis. We are going to be looking at ratio analysis. What is ratio analysis? Ratio analysis is a financial tool that is used by organizations to evaluate their performance by comparing one variable with another, by checking the relationship between figures. Ratio analysis is a financial tool that enables organizations to evaluate their performance. Therefore, what are the uses of ratio analysis? One of the uses of ratio analysis is that it aids performance evaluation. We have what? Uses of ratio analysis. Uses of ratio analysis. One, for decision making. For decision making, we have for performance evaluation. We have three, for planning and controlling. For planning and controlling. For comparison. 5, we have for comparison. We have for financial statement analysis. So these are some of the uses of ratio analysis. 1. Ratio analysis provides the necessary information needed for investment decision. In time of one, as an investor, if you are to make an investment decision, what are the variables to look into? You can look into earnings per share, dividend per share, dividend cover, price earning ratio, dividend yield, earning yield, and so on and so forth. You might also want to look at the profitability ratio, such as gross profit ratio, net profit ratio. Look at return on capital employed or return on investment. Look at asset turnover, and so on and so forth. As an investor, it is very important to know or to have the knowledge of ratio analysis in order to guide us in making investment decisions. It also enables us to compare. Ratio analysis also helps us to compare the performance of one organization with another in order to know which organization performs stupendously or excellently, and the factor that contributed to such excellent performance. Ratio analysis will provide answers to such questions. Ratio analysis is also used for financial interpretation. It enables us to interpret the account of companies in order to know some of the areas of weakness, and strength, and how manager uses such ratio interpretation to convert organizational weakness into strength. So these are some of the uses of ratio analysis. Now, what are the limitations? What are the limitations of ratio analysis? What are the limitations of ratio analysis? Look at some of the limitations of ratio analysis. One of the limitations of ratio analysis is what? It is affected by inflation. It is affected. Okay, let's take it like this. Let's say inflation. 2, accounting policies. 3, it is based on historical data. It's based on historical data. We have another one again, which is what? It is affected by what? By creative accounting. by creative accounting practices, etc. Now let's take them one after the other. One of the limitations of ratio analysis is inflation. Inflation, as we know, is the persistent rise in the general price level of goods and services in an economy. And when this happens, it affects the standard of living of people. Just like what we are seeing in this period of COVID-19, the prices of some goods increases. And inflation usually have an adverse effect on balance of payment of a country. So when there is inflation, the prices increases, and as such, the budget is now affected. And this might not be useful in ratio analysis. We have accounting policies. Accounting policies are basis principle, practice that govern the preparation and presentation of financial statements. Different entities or companies adopt different accounting policy, and this might affect financial comparison when comparing company A with company B. We have historical data. Historical data are past data. Financial ratio usually uses historical data, and such data are past data which are not useful in making decisions concerning the future. And this is one of the limitations of ratio analysis. We have another one again, which is what? Creative accounting. Creative accounting simply means financial fraud or financial malpractices. The effect of fraud by company managers or employees of any organization has affected the uses of ratio analysis in making decisions on planning and controlling business enterprises. So these are some of the limitations of ratio analysis. So these are some of the limitations of ratio analysis. Let's now look at some of the types of ratio analysis in financial practice. We have profitability ratio. We have profitability ratios. We have liquidity ratios. We have investment ratio. We have debt ratio, etc. So for the purpose of this class, we are going to be looking at profitability ratio. Profitability ratio is a financial ratio that enables business organization to know whether the business is performing stupendously or excellently when comparing the current financial report or financial statement with the previous period. To enable us to know whether there is an increase in profitability or there is what? Decline. An example of profitability ratio, we have what called gross profit ratio, net profit ratio, return on capital employed, asset turnover, individual expenses to sales, and so on and so forth. We have liquidity ratio. The word liquidity simply means what? Liquidity means the ability of an organization to meet up with its short-time debt as at when due. Therefore, there are different liquidity ratio we have. We have current ratio, we have asset test ratio, we have stock turnover ratio, we have debtor collection period, we have payment period, and so on and so forth. We have investment decision. Investment ratios. Investment ratios are financial ratios that enables potential investors or existing investors to decide whether to sell their investment or to invest more in a company. We have earning per share, we have dividend per share, we have dividend cover, we have any price earning ratio, we have any yield, we have dividend yield, and so on and so forth. So it enables investors to make investment decisions. We have debt ratio. Debt ratio and it enables company to know, it enables a creditor to know whether to give finance or credit to a company based on the financial statement. So it enables financial institution to make a credit decision whether to give out credit to a particular company or not. Now, finally, ratio analysis is a financial tool that compares or that checks the relationship between two variables, and so on and so forth. Now, let's now look at practical examples on ratio analysis. Now, we have the illustration 1 on the board. We have, in this case, we have two companies. We have John Limited and Amos Limited. There are two companies, and this is the income statement, and here is the financial position. We are now required to calculate for each company the current ratio, the asset test ratio, gross profit margin, net profit margin, dividend per share, any per share, debtor collection period, creditors payment period, dividend cover, and we have price any ratio, and finally, as an accountant, you are now asked to suggest which company is more liquid. Which company is more liquid? Now let's now look at the first one. The first one is current ratio. We have what? Current ratio. Let's look at current ratio. The first company is John. We have John Limited. And what is the formula for current ratio? Current ratio is equal to a current asset all over what? Current liabilities. Now, come to John Limited. In the financial position here, we have the current asset, we have inventory and account receivable. The total current asset is 70,000 naira all over. Current liabilities, total current liability we have here is 30,000, all over 30,000 naira. Now this divided by this, we have what? This divided by this, we have 2.1. We have 2:1. We have 2. In this case, we have 2.1:1. So here now, the ratio for this company is what? 2:1 for John. Now let's calculate for Amos. We have for Amos Limited. Amos Limited is what is the liabilities here. Okay, remember for John Limited, the current liability is we have 80,000 and not is 80,000 naira. We have 0.5:1. That's 0.5:1 for Amos. For Amos Limited, Amos current asset is 40,000 naira. 40,000 naira. You have total current asset together. Now have total current liability here, which is 30,000. So we have this divided by 40,000 divided by 30,000. We have 1.3:1. Here, the current asset of John is 0.5:1, while that of Amos Limited is 1.3:1. Now let's look at the second one, which is quick ratio. We have a quick ratio. Quick ratio is equal to current asset minus stock all over current liabilities. Now, here the formula for quick ratio, we have current asset minus inventory divided by current liability, and total current asset of John for John Limited is 70,000 naira minus inventory, which is 20,000. Our inventory here is 20,000 divided by current liability 80,000. What do we have? We now have 50 all over 80, which is equal to 0.4:1. Here we have 0.4:1. While for Amos Limited, we have the current asset, which is 40,000, minus inventory here. Inventory is 10,000. Inventory is 10,000. And current liability is 30,000. So in this case, we have 40 minus 10,000. We have 30,000. We have 30,000 divided by 30,000 is equals to 1:1. Here, when you look at this point, when you look at current ratio, the current ratio of Amos Limited is better than that of John Limited. And at the same time, the acid test ratio or quick ratio of Amos is 1:1, although it's 1:1, so it's better than that of John at the same time. But at this point, although both current ratio of the company is below the requirement of 2:1, but at this point, Amos Limited ratio is still far better than that of what John Limited. It's still far better than what John Limited. So this is the current ratio, and this is what the what we call quick or acid test ratio. Now let's now move to the next one, which is what gross profit margin. Gross profit margin. Let's move to gross. The gross profit margin is equal to gross profit all over sales times 100. The formula for gross profit margin is what? Gross profit all over sales times 100. And here we have John Limited. Gross profit of John Limited here is what? 110. We have gross profit of John Limited is 110. All over sales, the revenue is 200,000. The revenue is 200,000 multiplied by 100. Now this go. We have 20 all over this, 100, 1 here, 4 here. It's equals to 44%. Now this divided by this times 100 will give us 44% for John. Let's now look for that of Amos Limited. For Amos Limited, our gross profit here is 80,000. 80,000 naira divided by revenue, which is 150,000. 150,000 multiplied by 100, which is equals to, we have 8 all over 15 times 100. 5 here 3, 5 here 20. Okay, we have this times this, which is what? This times this, which is 160 divided by 3 here, which is 5, remainder 1, 3, 53.3. Here we have 53%. Here we have, now when you look at the gross profit margin of Amos is 53%, while the gross profit of John is 44%. At this point, Amos Limited perform better in terms of gross profit to that of what John Limited. So let's now look at net profit margin. Net profit margin. Let's look at net profit margin. And net profit margin is equal to net profit all over sales multiplied by 100. Net profit margin. The net profit margin is equal to what? When you're calculating net profit margin, is equal to net profit all over sales multiplied by 100. Now, when you look at the net profit, what is the net profit of John? The net profit of John is 28,000. We bring John Limited. We have 28,000 all over sales. The sales here of John is 200,000 times 100. Now we have 14 all over 100, so it's equals to 14%. Here is equals to what? 14%. We have for Amos Limited. For Amos Limited, the net profit of Amos is 35,000. We have 35,000 all over sales is 150. The sales is 150. We have sales here 150,000 multiplied by 100. So here we have this, we have 35 into 150. 5 here 7. 5 here 50. 5 here 50. So we have 5 here 50. We have 35. 5 here 7. 5 in 15. Okay, 5 here 3. We have 30. 7 here. We have 70. That is 2. That is 2. 2 points. We have 2.6%. Now here the gross profit, the net profit margin of Amos is 2.6, while that of John is 14%. So at this point we say okay, we have 26%. So we can say the net profit of Amos is still better than that of John. Now the next thing we are going to look at is dividend per share, earning per share, but that will be our next class. So I thank you for today, for listening and for your cooperation. So this is the end of the class. So your assignment will be very brief. So what I'm going to write for me is you are going to state the categories of ratio that is necessary, that is useful to creditors. This is your assignment. State 5 ratios that are useful to creditors or to financial institutions when making credit decision. Thank you very much. I love you all. Meet you next class. I remain the same. Public professor. People call me public professor. So I will meet you next class, and we're going to be looking at the remaining ratio analysis because of time. So thank you very much. Love you all, and I miss you.